It's all about nutrient efficiency, right?
Exactly.
I've taught you all the things that you know.
Oh, yeah, here we go.
I'm Sherry Cook. I'm passionate about helping farmers with crop nutrition, and I'm here to help you with your operation.
Test, test, test. Hallelujah. Great for a radio guy, huh? Technology's not always been my friend. Let me introduce once again Don Wick, Red River Farm Network, Tyler Donaldson, Jay Rader, Jamie Dickerman is with us, and Randy Conan as well. That's our team. That's keeping markets and farm news on the air on 23 radio stations all across Minnesota, North Dakota, and into South Dakota as well. So we appreciate you being here and getting in tune with what's happening in these markets. Tyler, you want to introduce our group?
Yeah, absolutely. Test one. Me too. Absolutely, Don. Yeah, we have a great group of panelists here, market experts for you all. From Don's left down there, we have Randy Martinson of Martinson Ag Risk Management, Bryan Doherty, Total Farm Marketing, and Kristi Van On and Company. And before we begin, we welcome your questions. We want this to be interactive. We know you guys have a lot on your mind. Don't be afraid to ask a question. Flag one of us in a red shirt down. We got microphones out there for you guys. So don't be afraid to ask any questions here. So.
Well, let's start. Big Iron always seems to coincide with a crop report. We always, seems like this week gets to be a time when those August numbers come through, or September numbers, I guess. Friday is when we're going to get the USDA report, and we had a shocker the last time, a record 188.8 corn yield, breaking the record by what, like 8 bushels? Are we going to be that full steam ahead in Friday's report? What are your expectations?
I guess, for mine, I think we're going to see a reduction in the yield. I think they, the August report actually used, the satellite imagery, they used the crop condition rating, so we knew it was going to be maybe a little bit exaggerated, a little bit big, just because, at this point, in August, everything looked green. I mean, weeds were green, everything looked good, so if you're doing satellite imagery, you're seeing a pretty good image. So now they're actually doing the in-field surveys. Remember last year when they did the September ones, our ear counts were a little bit lighter, so then that's led to the 3 bushel drop in the January numbers. So this one, I think, will hold a little bit more weight, and I think we'll see a little bit reduction. And I expect that we've seen the biggest yield already, and we'll see it slip from here.
What are your thoughts, Bryan?
I'm going to echo those as well. So if we take a look at what the USDA did with their satellite imagery, we looked back in July, so we looked at analogous years with crop ratings in July and found in 2 years, I think 16 and maybe it was 18, that if you extrapolate that out, the yield would be about 189, and sure enough, that's what the USDA more or less came out with because the crop rating stayed strong. Since then, I'm always looking for themes, and some of the themes that I get from customers, and we talk to farmers throughout the country, is that there's been some disease pressure, and then in the southern third of the Corn Belt, eastern Corn Belt, some dry weather concerns. And I think Pro Farmer probably has it more right in their tour, somewhere down around that 182 to 183. To me, the biggest number and the shocker on the report wasn't so much the yield, it was the demand. They raised demand 550 million bushels, so that brought up 2 questions for me, is where were they the month before and the month before and the month before? But nonetheless, those are some really big numbers and a reflection of sort of the bubbling undercurrent of demand both domestically and worldwide. And that's the good story in corn. So if the highest yield number is there, and the market is sure acting like it, the market bottomed the day of the report, down 13 cents, finished the week a quarter-cent lower, and has since rallied. It's actually got an uptrend intact, higher highs, higher lows, nice inverted head and shoulders formation, some targets above the market. So I'm not crazy bullish, but it sure looks like the biggest numbers are on the table for corn and for soybeans.
Kristi, your thoughts? I know you've been putting some miles on. You've seen some cornfields from the windshield anyway.
Yeah, so I mean, I can't stress that report was one of the most bearish corn reports I've ever seen in my history. You added over 1 billion bushels of corn production to the pipeline, and so that was a shocker in the market. But like Bryan said, you did such a good job fighting off that negativity. That was such a win for the corn market. So it does feel like this corn wants to build out of here. But one thing I'll note is that even if yield does come down, which I'm expecting yield to come down, I've traveled enough of the not so great parts earlier in the season. I do feel, I've been adamant on that yield is too high where it currently is. Even if you do that, the bottom line is because of, not only, you talked about demand, one of the most bearish factors of that report is they found a bunch more corn acres. And driving around, you see it almost everywhere, just the sheer amount of corn that's around the country. So even if that yield comes down, you're still going to be fighting that battle, and we need to see demand continue to run hot. I do think that this report could be the chance to have one of the friendlier corn reports for a little bit, because I think they'll come down on yield, but they won't adjust demand quite yet. Now, where we could see issues is December, January, February. If demand starts to dwindle to a degree, there is room for that demand to come down and offset any sort of yield decrease. And I fear that we're stuck around 2 billion bushels for a carryout, but 2 billion bushels is definitely doable, and we can work through that. But I'm really hoping that you can get a good report here on Friday. And if you do get that, what we're looking at is to try and get that gap on December corn, which is about 432, and then hopefully that gets you to 450 out into the March contract. And I know that isn't a price that you probably want to hear about right now and say that's what I'm shooting for, but I think that's a realistic number that I'm looking at this point.
We have big crop coming, definitely in corn, soybeans here, but it's not all rosy. There's always, disease pressures and such going on. There's reports coming out of the Eastern Corn Belt as well of flash droughting here. Do you guys see any yield drag going on with that?
Can I jump in on that? I do. Getting back to our conversations, I'm always looking for themes, and the themes, I'll start with beginning spring. To your point, maybe, Kristi, it wasn't the best spring nationally. I call it a good spring. So the first third, the second third of sort of the season was excellent. That hid the sins of the first third. And then the last third goes back to disease pressures and, to your point, flash droughts, dry conditions. Anecdotal evidence, a farmer I know in south central Indiana about 6-7 weeks ago told me best crops ever. They went dry. He told me 4 weeks ago they were going to be down about 10%. They're starting bean harvest down 25% from their expectations. So there is some impact of weather and disease. I don't know how to put my hands around the rust issue, but it's out there, it's real, and anything that's real does have some drag on that yield. So like Kristi said, she's gotten around those fringe acres that were added. Usually when you add acres, you don't add yield. That's actually yield drag. So
I guess I wouldn't, talking about the spring and how the season went, I think they might be that 2 million acre or 2+ million acre increase that they had in the report, I think is maybe a little high too. I think there's a lot more holes than what are leading most people realize out in the fields. And again, once we get the combines rolling and we get some reports on the harvested acres, we'll know a little bit more. But I would expect it probably will take till the January report. We might see acres down a little bit as well.
Still think there will be a record crop though, or?
Well, I think it'll still likely be a record. That I think is pretty much given that we'll see a record crop, but it's not going to be much bigger than last year's.
Why don't you pull that mic a little closer to you, Randy, if you would. All these guys in here are looking at a pretty ugly basis. We're hearing more and more elevators are not taking a bid for soybeans, trying to save some from bin space for their corn crop. I guess your take on where we are in this cash market, because that's ultimately where most of these guys are going to sell this crop.
Well, nothing short of ugly, on the cash side of things. I think the biggest problem lies in beans right now, and that got compounded this weekend with the frost. So now a lot of guys are going to have to look at finding more bin space for soybeans, especially if they got nipped a little bit and they got some green beans in there. They're going to have to store them for a while, or really take a big discount at the elevator, if the elevator will even take them. Of course, up here, we know there's areas that have refused to take soybeans this fall. The basis levels are at 150 to 175. So I think at this point, you might be better off storing some of those soybeans. That basis will get better as we get later into the marketing year. If China does come on board and start buying some soybeans, that's certainly going to help quite a bit. But right now, that's kind of the double-edged sword we're facing, is that with China out of the market, we've got nowhere to go with half of the beans raised up here in the northern plains. Half of them will go to the crush plants, but that's also kind of spoon-fed over time. So I think, if a guy can store the beans, which we don't like doing, that's the better part. Corn has a carry. You'd like to take advantage of it, but if you have to choose one, I think I would put the beans in the bin at this point and try to deliver a little corn, or look at putting corn on the ground or storing it in bags.
That's the question I was going to ask you, and I see a lot more corn going in the ground. Storage is at a premium before the wind event we had this summer.
Exactly. I see some guys leaving corn in the field and waiting till spring to harvest it.
Yeah, I think when you look at basis, the tough thing is, for a lot of people, you need a home for it. And so it's one of those like lesser of evil things. Like, do you want to eat a bad basis and have a home for it and be able to keep moving along during harvest and be able to get some cash flow going, or do you not want to and have to deal with that, putting something on the ground? That's where I start to really struggle. And I think one thing a producer really needs to think about is the cost involved in that. Like, so we're not talking just, some spoilage, some issues, right? You're talking about having to bring that corn back to your farm, put it on the ground, and then come back, pick it up, bring it back to the elevator. And those are the costs that you need to really consider into that situation. So when I look at it, bean basis is absolutely awful in a lot of places, but I am fearful that it could get worse in the short term, because let's say China does come into the table and start buying. You're still seriously looking at a couple months before you could see that demand start to come off the P&W, move by. You have all of these places that have old crop beans still on hand, and so I just worry about that situation. So what I am looking at is that if you're looking at and saying, I don't have storage for everything, I think you just have to take the lesser of evil and just say, I'm going to find a home for something to make sure I can keep moving harvest along and find a home for it. So I'm not opposed necessarily. Now, I'm not dealing with the 150, 175 basis, but you have some places that are 115 to 120. And if you look back at like the last time North Dakota was in a trade war, you were looking at, 180, 190 for a basis. And then you're starting to talk like $7 cash beans. And right now you can still get $9 cash beans. And I think that's just something that you really got to consider. And if you look at where corn is, I think that corn has some friendly aspects to it. You look where wheat is, wheat's on the lows. I guess if you had to choose one, I'm not necessarily opposed to beans, but it's not a fun decision by any means.
We're kind of at the end of the chain. Everything's going to the P&W, but are we seeing basis, what's happening in the river markets and some of the other parts of the country?
I was hoping you weren't going to ask me any basis. Anyway, John Newton was here this morning, and John talked about other parts of the country as well, and we see it same problem down south. Bean sales on the books right now are their lowest in 7 years, so it's not a robust start, where corn is a very robust start. Corn's actually, if I remember the math, we're at 25% of sales on the books already of projected exports, which are already high. So that's a really good story there. Beans, it's a wait-and-see game. But down in the south, same problems. They don't have as much storage, so they're dealing with the same questions you guys are dealing with. How do we handle it? What do we do with? Every situation's unique. I don't think there's a blanket average answer for every question on this. It's probably more of a one-on-one type conversation. If you work with somebody like one of us, to work through that and see what might be the best strategy. I guess when I step back and take just a little bit bigger picture perspective on this, if I had to take a bet, if I have to take a bet somewhere, I'm going to store my beans. I'm going to bet that there will probably be a deal with China. I was looking at some numbers beforehand. We're looking at Brazil maybe meeting all of China's needs, 112 million metric tons. So let's say that they do. The world's still going to import 174 million metric tons, or 176, somewhere in there. The U.S. is about 44, so there's still lots of beans left over that have to go somewhere else and come from somewhere else. And so if Brazil's meeting China, if that's the preferred customer, we're going to pick up business elsewhere. I think it's just a matter of time. China, I think, is playing the game right now. They're not in a rush. They've got beans on hand. Do they want to draw down their inventory, or do they want to hold their inventory? I'm hopeful that they either extend an olive branch and just start buying for the sake of buying because they need it and we have it and it's cheap, or that there's a deal worked out. So my bet is to store the beans and probably be a little bit more aggressive selling corn into the carry or moving corn if you can move it. There's still going to be some storage issues. I don't have an answer to that other than what Randy said. Maybe you put the corn in the ground. I have asked a good number of farmers, would they be willing to keep their corn in the field? And I've got a pretty resounding no. I don't want to do that. There's too much risk.
See, I've got the opposite answer.
Yeah.
But a lot of that is maybe to drying.
And I grew up
too.
on a farm, and just because we farmed a lot, the corn was in the field in December or January. So I'm of the opinion that I think that's viable, but maybe, farmers aren't comfortable with that, and I get it,
A lot will depend on how much it'll cost to dry it when coming off the field. And, a couple years ago, we were stuck where we had really wet corn and it was going to cost close to $100 an acre to dry the corn, and a lot of guys left it in the field over the winter. Turned out to be a good winter, and it worked out, and the corn was dry coming off in the spring. Now, I heard Daryl Richardson on the way here today, and I don't think we're going to get that same winter that we're planning. So, of course, you never know what's going to happen. But one of the things, you talked about the corn demand. What we're kind of seeing there is a trade-off, though. What we're seeing is maybe a little lower feed demand and more exports because 120,000 head of cattle or 1.2 million head of cattle are still in Mexico. And Mexico's buying the corn from the U.S. to feed them. And I don't think we're going to see that border open up anytime soon, but let's just say it does open up, then the cattle will start crossing the border again. And then we'll start seeing the increase in feed demand and less exports. So.
Yeah, I'm a little bit concerned about feed usage. I think it's maybe a titch high when you look at the corn market, but once again, I don't think they'll probably acknowledge that for a little bit.
Right.
So that would be my hope, is that they push off any sort of demand change in the corn market for at least a couple months before they adjust that. And if you can get that yield decline, I think you could get one of those lower carryouts for the time being until we can work into March, April, May timeframe.
I want to go back to beans, and I said if I had to place a bet, one of the things that, when I try to analyze a market, I look at all the supply factors and all the demand factors and kind of put those in a funnel, and what comes out at the end is carryout, the supply left over. And so last month, the USDA had some interesting numbers. They lowered acreage, increased yield, and lowered carryout a little bit. It's 290 million bushels. With a yield of 53.6?
6.
And that's a record yield. So last year we were at just under 51. So if there's some disease issues or this drier weather in parts, or flash drought, as Tyler said.
Frost.
Or frost, or this or that, right? So maybe there's a chance that yield comes down a bushel or two. Well, 1 bushel yield reduction would be 80 million bushels because there's 80 million harvested acres. That's carryout at 210 million. That in and of itself could be bullish for beans. So if you take any more off, you could see a really strong rally in soybeans in a time window right now where nobody seems to be too much optimistic on much of anything, but there's an outside opportunity. We could see a really different market in several months from now, in particular if China comes in and starts buying.
How about wheat markets? Let's not forget them.
Let's forget the wheat.
Yeah.
All right, moving on. But seriously, though, how are they holding up, if you could even say that here with just global competition and the weather going on?
Yeah, I think when you look at yields, they've been strong for wheat. It's just you're on contract lows. There's nothing really on a push-on basis, and so we're stuck here until we can get a story. I'll tell you, when you break down kind of the world environment, world carryouts on wheat, it has the ability to be a friendly atmosphere, but we need something to happen first. We need a spark in a different country. We need some sort of country to have a problem to be able to do that, and until we can see that, we're not even picking up any sort of demand. So even if you look at like winter wheat, for example, the low price that it's at, even at those levels, we're still not picking up the export demand like originally I think a lot of people had hoped we would see. You're still seeing a lot of cheap wheat come out of Russia, and so we're stuck here trying to figure out what to do with it. And I would imagine really if you wanted to see a big spark in wheat, it might have to be all the way until a lack of winter wheat acres planted, possibly we see the reduction that we're seeing in spring wheat. Not that it can make that big of a difference, but until we can get that, until you can build out of here, we're really just hovering towards that bottom and making new contract lows or not being that far off of them, and we just can't seem to get anywhere.
One thing with wheat, I mean, we do have good demand. I mean, our wheat exports have really improved over the last couple of years. So, I mean, that we kind of solved part of that problem, but then the rest of the world produced a little bit more, especially when you look at the major exporting countries. And, you know, now we did get a little friendly news with Canada seeing a little smaller stocks that came in the Stats Canada report here earlier this week. But, you know, in the big picture, yeah, it's going to take something to drag wheat up. And right now, I think it's going to have to be corn that helps pull it, because there just isn't anything. Now, they got some good rains down in the southern plains. They're likely going to get started planting winter wheat, and it's going to fall on where those acres come in. That's going to be kind of the start of the catalyst for what wheat's going to do, if it's going to continue to waffle at lows or whether it's going to show life.
So the 800-pound gorilla in the room is tariffs in China, those kind of things. I'm curious, have we seen with the current tariff strategy, these trade flows that we typically have seen change? Obviously, we know the Chinese market isn't there right now. What about other parts of the world?
I'll jump in.
Good.
Well, we got trade deals with Canada, Mexico, European Union, and there's one other. So things are happening, but demand is one of those things that just doesn't blow up. It happens over time. And to Randy's point, you look at the wheat export sales, not too bad. I think the 800-pound gorilla really isn't so much all the political, that's all music and chatter and noise. It's just that the world has produced really good crops the last 2 years in particular. I'm tired of talk about themes, I'm tired of the word record. Every time you turn around, it's a record crop, a record this, record this. And those who know me, you know, I'm sort of sarcastic, but I've heard this, climate, every time you go anywhere, climate change, man-made climate change, climate change. The world should be grateful for climate change. It creates world supplies of food that is keeping the world amply fed at cheap levels. It's not great for farmers, necessarily price-wise. So if there's some disruptions along the way, I think we'd be surprised how fast money flow will move into commodities, particularly row crop commodities. We take a look at like the corn market. We track the Commitment of Traders report each week. It tells us who's in the marketplace. And the managed fund money was well over 200,000 contracts short. They're less than 100,000. They're moving out of corn. They're buying their contracts back, and they typically don't get any more sold this year. So really, to me, the big story is the low price environment is going to create demand by economic definition. We just need some disruption, a catalyst, something, somewhere to have somebody say, I need to buy this, and I need to buy today, and I need to buy more tomorrow. And that hasn't been the case. We need a cattle market is what we need in the grains. Speaking of cattle, the weights are heavy. I don't think the USDA is going to move the feed demand on the cattle too much. I do worry about the feeders coming in from Mexico, but gosh, when I talk to cattle producers and the weights they're pushing these cattle to, and the hanging weights, and they're building bigger facilities so they can hang the bigger cattle, that's a good demand environment for grain.
It's been a lot better to walk the corn off the farm than it has been to haul it. So pushing those weights has really helped bring some return back on the corn that's been sitting in the bins. There's no question about it. But you know, that cattle market, you know, that's another animal in itself that is right now looking a little bit, I'd say suspect and ready for a little bit of a turn down. You know, you look at it, it was September 9th that we bottomed out the feeder cattle contract, and now we're over a year long, almost a full year bull run in that market, and it gained $126 in that time frame. That's a big run in a short period of time, and only about 5 or 6 setbacks during the whole time frame. So there wasn't a lot of retracements during that time frame either.
Can I add on that? The live cattle market increased 16% in value in a 6-week window here recently from the recent low 6 or 7 weeks ago now. What else goes up 16 or 17%? You can't expect demand to build on that, and higher prices are not an environment that builds demand. So, but demand doesn't fall off, but it will start to wane, and I think the market's starting to feel the effects of it. Not that I'm bearish on cattle, it's just I don't think you can continue to chase beef prices higher. I think the Sam's Clubs and Costco's and Texas Roadhouse, I think they're actually probably losing money on their beef just to get people into their store and charge them $8 for a drink and make their money there. So I know we segued into cattle, but I think if marketing never takes a day off. So whether you're a cattle producer out here or a bean producer, corn, you gave some target points in corn, I think those are all viable, right? Put your target points up there. Let those get triggered. Start marketing on a rally. Don't wait for the market to be painful before you think about it.
Yesterday we had the feeder cattle limit down, but live cattle were weaker, but not limit losses. Typically they move a lot in tandem. Was that any surprise?
Yeah, it was. I mean, I think the feeder cattle felt more of the momentum. You know, they've had the bigger run up. They had they were more vulnerable for a little bit more of a downturn. And so I think that's kind of why the feeders saw a little bit bigger setback. Cash, is also seen a little bit of a pullback. So, I mean, we kind of had two of the three items that kind of have continued to help push this market, and that is, higher cash and strong demand, have started to slow down a little bit. And now the volatility, whenever that gets to be as big as it is, you always start to see possible change in the trend too. Volatility is extremely big in cattle because, just looking at the numbers, I think we're vulnerable for a setback in that market. I think we could see, a pretty good retracement. And if you look at a 50% retracement in feeder cattle, it's $56. I mean, it's a sizable retracement. So I do think guys need to have floors underneath feeder cattle right now, and even live cattle in the short term. I don't think we're done. I don't think cattle are over because we haven't solved the initial problem, and that is tight supplies.
Test. There's a bit of a disparity between the two markets, the crops and the cattle markets. Can that momentum continue, do you guys think?
What was that?
The disparity between the crops markets, row crops, and the cattle markets.
Yeah, I think that, overall, I look at this pullback that we saw in the cattle markets, and I just think that a lot of it comes from technical side of things. So fundamentals, I love fundamentals. Like, I love digging into numbers. I love that side of things, but sometimes they just don't matter. And I think that's what ended up happening to the cattle markets, is that you had technical sellers want to come in, you broke some key support lines, you broke some key moving averages, and it's kind of that snowball that you start to see it and you're like, oh my gosh, feeders are approaching limit lower, and people jump on board to short that. So I think that's kind of where you saw that situation happen. But I will tell you that any sort of friendly, bullish market that you need timely pullbacks to bring in fresh buyers, and without that, you're going to run out of steam. And I do think that this is probably a good, healthy setback for the market to bring new buyers in and be able to extend higher if it wants to.
I think as long as corn is cheap and available and
Right.
feeds are, the feeder market's going to stay active. There's just it goes back years and years to when the West was continually, I call the West, the Western Midwest and cattle countries, really sticky droughts and poor pasture conditions, and then the run up in grain prices, and then the demographics of the cow-calf producer, and a lot of things kind of converge to reduce this herd. Now it's a weird economic environment where do you, as a cow-calf operator, do you hold back heifers to build your herd? There's so much cash in hand, right? So the market's going to have to figure that dilemma out. Or beef is the new lobster. It's just, people aren't going to use as much beef just because they can't afford it, and those who can will buy it regardless of price. So, and we think that's maybe some of what's going on here, because there's such an inflationary environment in food that if it was just beef going up in the store, you would say, wow, I got a glass of lemonade for $7 today because I had no other market, and I needed something to drink. But it's $7, okay, and you just give up and you pay it anyways because you're not going to go on a vacation this year, but you'll at least have a good steak, maybe. But that only lasts for so long. I don't know how we got out of this pickle with the herd growing. The dairy industry is doing its best to try and help, and that herd is growing. But it's growing for the beef calf more so than it is for the heifer, for the dairy heifer. So a lot of interesting dynamics in the livestock market.
If I can switch gears, Congress passed the One Big Beautiful Bill this summer, included a lot of things on the tax side of things, and also enhancements in crop insurance, increase some of the guarantees, updated reference prices, and those kind of things. How important is that part of our risk management plan for these producers in combination with what they're doing on the market side of things?
Boy, well, I suppose I should take that one first. You look at it, you've got the subsidies that they came in, the upping it, with the area plans, they've really made the ECO and the SCO and those so much more attractive when they've upped the subsidy, and now making it so that you can cover, 90 to 95% of your crop. So, I mean, it's worth taking a look at. They've upped the subsidies as far as the lower, the regular MPCI policies too, the RAs and so it's all kind of coming together to make it a little bit less expensive, but covering a little bit more of your crop. So area plans aren't one that's going to tie into what your actual farm is going to produce, but it's still going to give you the opportunity to lock in some pretty good levels and like this year, we're looking at some pretty good levels and the possibility of some payouts on some of those 95% ECO policies that were bought. And you're buying now. Up here, we used to not be able to afford doing anything much over 75% coverage on corn or soybeans because of the premium. That's now going to become a little bit more attractive. They've given an incentive, of course, for beginning farmers and veterans. They've increased the subsidy for them again for another 5 years. So, they're trying to, on the backside of things, make the risk management a little bit more stable.
They also added a margin coverage plan. What does that do?
You don't want me to talk about that. There is a margin ECO product that's out. It's kind of like margin protection, which that helps cover your margin of your costs, and it's certain costs that they use. It's mine. So it will help cover the margin, but when looking at it, and it takes in the price that's going on right now too. So the advantage is that it'll protect your margin and it'll lock in the November price now for what it's trading at. Is that worth the trade-off?
Big iron exhibitors, and yes, today's 50-50 drawing is currently over $500 and climbing. Get your tickets from Air North Carolina on the grounds.
Hurry up and find the guy selling tickets. So anyway,
Get your market there.
Yeah, get your tickets now, quick. No, in reality, what it does is, it helps protect part of the margin. It covers the fertilizer. It covers, I think, the fuel. That's the big ones. But that's a small part of the equation when you look at what what the insurance is covering. Price and yield make a bigger decision on what happens. I don't know if I would be willing to, just because of the way we're talking, we think there's opportunity in the market. The margin protection locks in price now. I think you're going to see a better price when you get later in the spring. And I do think that fertilizer prices are going to come down, or input costs are going to go down as we go into the winter and into the spring. So right now I lean guys a little bit more away from the margin side of things and more towards looking at ECO in the spring when you're doing your multi-peril.
Does that impact our skills as a marketer when we've got that kind of risk protection behind it?
I'll jump in. I don't know. I think it depends on the individual. So I have a lot of thoughts on this whole. So ARC, PLC, those type of things boost it, right? That comes into play next year. As far as the insurance enhancements, I would still make the argument that insurance is insurance and not a marketing strategy. And so I think you have to marry the two and use them both to be good marketers. And I think this year is an example. So I had some customers that they paid up on the insurance, which was a way for them to put a floor, so good for them, but they got away from marketing, and because they had this, and they said, well, I'm just not going to do anything unless the market rallies. Well, when D's corn is at 475, and it wasn't there very long, it was, well, I'll pass, because normally they might start selling because I've got what I think is going to be a better insurance level. So I would say you have to marry them, look at it together. What concerns me on the kind of the bigger picture is the more the government gets involved with providing price flooring mechanisms, and now I'm going to put my disclaimer, this is all my opinion, but you're creating an environment where you're creating a margin that gets smaller and smaller and smaller because you need to produce more and more because everybody's got protection now. So how do you make money? You produce more. And the dairy industry is a good example. They produce more. Their goal is to outproduce their neighbor. So your operations are likely to get larger and larger because they can squeeze out somebody who can't work on just a little bit smaller margins than they can. So philosophically, I guess I have some concerns. What happened to the freedom to farm mentality? Or do we as a society say, so what? We want a lot of cheap feed and grain, and this is a way to make sure that we have peace and world food. I don't know. It's too philosophical for me. But
you're exactly right. Insurance is a tool, but you still have to market your crop. And
well said.
Just a reminder, if you have any questions, just raise your hand. One of us will get a microphone in front of you so you can ask these guys, and we'll get the info to you here. With prices where they're at, I don't know if anyone's going to be selling anytime soon, but when that time comes around eventually, we always talk about the need for an exit strategy or an exit plan. You don't want to time the markets or anything like that. What sort of market indicators or signals should farmers be looking out for here when developing their selling strategy?
Yeah, I think, one, you could just go based off seasonals, right? Seasonals have proven very strong in the corn market. Obviously, our high came a little bit earlier than anticipated this year. But even looking out, like, let's say that you can store, for example, your corn market. December and January typically provide some really great basis pushes around the state. And if we can kind of bottom out here this harvest and be able to get up to some of those higher levels, I'd be looking at trying to get some HTAs done off the March contract so you can take advantage of the carry. These are all things that you can be doing without a trading account, right? So the carry right now, when you look between December and March, you're picking up anywhere from, depending on fees, 15, 17 cents. And if you're going off March, that could mean that you can deliver in January, and usually January can provide a nice push on basis levels. So I would just be looking at those opportunities there, even your deferred contracts. When you talk about, you got corn up to 475, that was last spring. We got up to 469.5 this summer. We are not all that far away from that level out to the July contract for corn. So if you could even put 15, 20 cents on this market, you have that opportunity if you can store your corn that long and hopefully pick up a little bit of a push on basis. So I think those are things you could be talking about. Same situation. Soybeans are going to be a little bit trickier this year because what you're looking at for soybeans is you're literally betting on China. And if China does not come to the table, I would not be surprised if beans are $1 to $1.50 lower. If China comes to the table, you're looking at, a significant rally because our carryouts aren't all that large for soybeans. So you're betting on that. But what we do know is that China likes its beans between harvest and like February timeframe. So if they end up coming to the table, I'd be looking at, once again, a March HTA and trying to get that push on basis into that early part of the year.
Back on China real quick, since you mentioned it, I did want to ask earlier, last week, President Xi Jinping hosting a number of leaders from that side of the world here. Seeing them all getting together, what does that do here for the trade over here on our side and for the prices?
That's a political question. I have no idea. I think the goal was to send a signal that Trump's not the only guy in town. I think it was visual.
What kind of came out of it, too, was that India pushed back on it. It was actually, China wanting to get these guys more in tied with each other and do more trade. India pushed back on it because they didn't want to be on the wrong side of U.S. I believe even Brazil pushed back a little bit, because they import a lot of beef to the U.S., and at a 50% tariff, they don't want to see that anymore, increase any more than it is. So right now, they didn't quite get what they wanted to do out of that meeting because nobody really wants to go against the U.S. at this point and see the retaliation.
But the message?
Yeah, the message, though, was negative. Even if China didn't get what they wanted out of this, the soybean market was actually on a great move prior to this. So you were really opening up some targets to go back up to those higher levels that you were at for crop insurance prices, and it just killed the market and really took away some of the wind from the bull sail. And so instead of being able to significantly get through this 1054 level, we got through there, got that news, and now we're kind of hovering back here around this 1030 to 1050 level, and now you find yourself stuck in this range, that corn stuck in this range too. And so I think the mentality of it did really hurt the market. And otherwise, I think without that meeting, you would have been able to get to some of those goals, and hopefully like that $10.74 up to $11 to do some bean marketing, especially for beans that have to go to town, but we just didn't get there.
You know, I'm going to agree with that. It seemed to kind of stall the momentum, but what stalls momentum? What stalls momentum is the money flow.
Right.
Where's the hedge fund managers? Are they willing to buy into this or not? And they kind of take a tepid approach to this right now. It wasn't a bullish meeting for the U.S. That was my takeaway on it, but I don't know if it changes the big picture much. We still got a little bit too much supply in the world, and we need a catalyst. So back to kind of the point here, I think you need to really look at strategy and think about, like in soybeans, we talk about, you know, if you listen to us, it's like, well, they say it could go down or it could go up. Well, that's right. So how do you handle that? How do you put yourself in a position to make it what I call a balanced approach? So you're ready if things blow up, they're ready to move lower. So my messaging there would be just, you know, have conversations with the right people, know your cash tools and what's available to you, and then talk to your advisor and know what paper tools you have available. So I had somebody the other day, and they're kind of throwing their hands to the wind. I said, look, just keep your life simple. Sell your beans, buy a bull call, spread out to July. You got a fixed risk-free ownership, you got your cash flow, you know what you're doing. The big weight off his shoulder. Time will tell, you know, whether that was good advice or not, but it can't be bad advice because we're positioned either way. I would say bad advice or bad suggestions are just wait and see what happens. Usually I've got a phrase that if you wait around long enough, you can sell cheaper, you can sell lower. So that was just so though that came from my childhood. My dad waited around forever to sell everything cheaper, right? So store and sell cheap, yeah.
It used to be that we focused, you know, supply demand, and that was it. It seems like the headlines drive a lot of what's happening in the markets. We saw Russia last night with a drone attack that went into Poland, a NATO country. Some of those big picture political type issues, geopolitical issues, how much attention are you paying attention to those headlines?
Oh, on myself, I try not to even watch them. You know, I mean, they make a little splash in the market, but in the, you know, long term, they kind of disappear. I mean, you know, when Russia invaded Ukraine, we had the market, you know, wheat market rallied sharply higher. We were going to run out of wheat, and the world was coming to an end. And within 6 months, wheat was down on its lowest, and it's consistently put in new lows since then. Yeah. And actually, Ukraine is producing less wheat now than they were when the war first started. So, you know, it's news and it's fodder for the market, but in the big picture, it really doesn't change a lot of the dynamics that are happening when you look at the supply and demand issues.
I've always said it's hard to outguess what politicians are going to outguess and how they're going to behave, right? Because it's dynamic, it's fluid, it's moving. So it's a challenge. So we give it our best shot, but that takes me back kind of full circle to I'll concentrate on the strategy. So if things completely fall apart with China, we're prepared for it. If they come in and all of a sudden they buy and they buy big, and you know there's a trade deal and everybody's happy, and now there's dry weather in Brazil and all of a sudden beans are up $2.50, $3, we're ready for that as well. So it's a matter of the focus. The political side's really a challenge to try and understand. And we're talking world leaders, now get into the U.S. Congress and what each politician is thinking there. Again, I don't know where it was today, Don, but the talk was, you know, in some of the big cities, their view of agriculture is more about conservation and SNAP programs and food, where out here, we're more about how do we support the farmer to grow more. And that's a tough environment to try and outguess.
With China occupying such a big space here for our exports and the current game of chicken going on, if you will, we are starting to see other Asian countries really start to pop up now. Vietnam really comes to mind. With a young population, they need protein. They're willing to buy, it seems, here. How does that impact our trade and just, our market prices?
Yeah, I think we're in such a good spot compared to where we were last go around for the trade war, right? So if you just look at the sheer amount that we've increased in crush demand, that's one of them. But like you said, we were so reliant on China, and now you have more countries. Even Mexico has been willing to step up and buy. And so I think eventually you could get your story, right? So if China doesn't come to the table, I think that you have a ag secretary that's been talking to farmers enough that she's going to go and say, hey, we need to find some trade deals and find another country to buy our soybeans. I do think she's the type of person that would do that, and I think Mexico's been one of those ones that's willing to do that, but it still is going to wait on the market for a while, that you have to wait for it, and usually this is your really nice time frame to be able to capitalize on that.
And I'm going to throw one thing on just to piggyback on what Kristi said. You know, for corn, our top 3 buyers right now for U.S. corn is Mexico's number 1, I think Japan's number 2, and you'll never believe who number 3 is.
Morocco.
Colombia.
That is surprising.
I would have guessed Vietnam, or they're 4 then.
They're 4th.
Okay.
So yeah.
Yeah.
So Colombia is a huge buyer of U.S. corn right now, and that has happened in the last couple of years.
Is that because of the Colombia trade deal we did the last go-around with Trump, or?
I don't know why, but yeah, they're just in and they're buying aggressively. So I mean, they've been more consistent buyers.
Well, I think it's that, but it's also done the trade deals, but it's also just it's a very cheap product
Yes.
to the world. If you think
It's
of
the
it from
cheapest in the world right now.
If you look at the price of corn or beans, it doesn't work for American farmers producing this, right? Or maybe some can break even, or most people are underwater right now. We see those numbers. Well, that means it's a bargain for everybody else. And if you're in Colombia or wherever you are and you want to build a livestock operation, you've got a viable source of cheap, great product that you can import. And it just economic sense that low prices eventually drive demand and help to cure low prices.
General consensus seems that we're going to see an interest rate cut when the Fed meets next time around. If we got all the governors show up, we'll see how that works. But it's been obvious the president's been pushing for a change in interest rates. He's been really aggressive with Chairman Powell. Seems like encroaching a bit on the independence of the Fed. There's always been that the wall between that. Is that a concern moving forward?
I think it'd actually be beneficial towards commodities if you start to talk about inflation and start to talk about those concerns, that you could see some buyers come in, and I think that could be just another little bit of a friendly story on the back end if we can get something out of Friday to help build off that. But you are starting to see where you were initially thinking 0.25%. Now you have people leaning towards even 0.5% out of this report just because of jobs numbers and kind of seeing that situation. So I think in the long run, you could actually see that be beneficial.
Your thoughts on the interest rate environment?
I think we'll see an interest rate reduction here for sure. You know, I was leaning more towards a 0.25 point until this jobs report came out this week, you know, that revised, last year's numbers down 911,000. So now we could be getting closer, approaching to a 0.5 point reduction. And I think the bigger part is, report integrity. That's one of the things I think that is starting to maybe increase its volatility or increase its concerns because of the unemployment numbers and then with the Fed. So I think that's what's going to be watched going forward here.
Don, we have a question in the audience. Jamie?
I don't know if you've touched on that, but I'm wondering if any of you could speak to a couple of the specialty crops like barley, canola, or dry beans.
You want to go, Randy?
We're all pointing at you, Randy.
Yeah, all looking at me, as far as barley, of course, I think our production is going to be up a little bit this year. Overall, quality is going to be somewhat of a concern, especially with the stuff in the northwestern part. So that's a market, I think, that, and of course, you got to store it for 3 years before anybody will take it. So that's going to get to become a little bit more of a problem. For canola, I'm hearing some disappointing yields coming in a lot of areas right now. It's not helping that you've got China and Canada at war with each other because of whatever reason, and they've got a 76% duty. China's got a 76% duty on canola going into China right now. So it's virtually shut off all Canadian exports to China. I think our biofuels industry will, still continue to absorb a lot of canola. Their stocks were a little bit lower Their projection for their production this year is a little bit lower in Canada. Canada's virtually kind of maxed out on what they can raise for canola, for acres. You know, there is a strict canola rotation for years, and they've maxed that out. So they're not looking at increasing acres anymore up in Canada. The acres increase have to come out of the U.S., and they're trying to do it here. And our biofuels, the renewable diesel fuel is certainly pushing towards that. Dry beans, the biggest trouble you got there is we export a lot. And if we need to get the trade deals done for the dry bean market to continue to be somewhat stable. You know, a majority of the, pintos go down into the Hispanic countries, majority of the others go into Europe. So we need trade deals with those for that market to be able to kind of flourish, you might say.
We're heading into the home stretch here. We only have a couple minutes left. Before we get to the summaries, though, I just want to take a look ahead to 2026. What commodities do you guys think have the highest upside here heading into next year?
I guess I'll jump in. You know, as we were talking before, I wrote down D's 26, corn, November, beans. So which one has probably the best upside potential? I'd make the argument for soybeans just because of how fast they can move. And to me, the carryout number is still a story that's untold with this year's crop, which implies that I don't believe the USDA is accurate at 53.6 bushels an acre. So I think we're going to tighten the supply up. As far as corn is concerned, it's been a very reliable production crop. Talk to any farmer, they'll tell you they'd probably rather grow corn than soybeans because they like the dependability. They feel they can manage it. What they do to get better yield creates better yield with soybeans. It's still a little bit more hit or miss. But top upside targets in corn, D's corn's trading over 450, not a really attractive price yet, considering we're talking a lot of time. But in that 470, 475 area, I'd start targeting and get 5 or 10% sold and just keep selling into that rally. If you've got the wherewithal to retain ownership, if you want to do that, I would be buying call options now on the 26 and set several target points to get to my 35% sold on value. So that's a big number for me. I like to sell a third of the crop on value. I don't care what the outlook is. If I can make money at it and I can cover those positions, I've got a really good start to a strong, let's say, marketing year, alleviating some stress. I'll tell you, the biggest thing I think that's killed farmers this year is just the stress. The markets aren't moving. They don't rally. When are they going to rally? You wait week after week, month after month, month after month. Soybeans, I guess I would target November, $11, start making sales and make sales up to $13 into that 35% window.
Randy, where do you see optimism in this market going into 26?
Well, I do think that for 26, I would expect that corn acres will see a little bit of a pullback. We'll plant less acres, mainly because of the input costs where they're at. So that'll help a little bit. If we can keep the demand structure strong like it is now, that's certainly going to help. It would be nice to see year-round E15. That certainly would take care of a lot of problems now that California's kind of seen the light, we hope, and improved it. Hopefully now the rest will, and we can make it a year-long thing. I do think the biofuels side is going to help push our markets because it's going to have to be more domestic demand. We have to rely more on domestic demand and less on exports. So hopefully that means we get a few more crush plants, we get a little bit more consumption in the U.S. on that side of things. So I'm friendly beans, but I think, corn will probably have a little bit better chance because I think there's going to be less corn acres, a little more bean acres. Wheat, that's going to be less acres. Right. And it's going to become a specialty crop.
Yeah, if I had to choose one, I'd probably look at corn just because I agree with Randy that I think you're going to see some acres come down in corn. I think the demand structure for corn has just proven that demand is hot right now for corn. I don't see that really changing all that much. I think my biggest fear when it comes to soybeans is that, once again, if you don't have China coming to the table, the average estimate for the Brazil production for next year is ginormous, and they have not even planted this crop yet, so let's keep it at bay. However, beans in Brazil have proven to be very successful, and they continue to find more acres to go to soybeans. So even if you had a less than ideal situation for growing conditions in Brazil, you're still looking at the acreage number being so large large that it absorbs some of those issues. And so I do think that Brazil is going to take advantage of kind of the relationship between the U.S. and China right now and try and say, I can feed you the beans you want, continue to work on this relationship with me. And to be honest, any sort of trade disagreement that we've had with another country over the last 6 months, Brazil has been in the backdrop coming in and saying, hey, let's figure something out. Let's work together on this. And Brazil's been very strategic at doing that move. And before you know it, we can see what they've been able to do with soybean production over the last 5 to 10 years. That's what they're doing. They're going to try and take advantage of every situation. So I do think that even, if we have this trade agreement and you can get those rallies in soybeans, I think that we're in a situation where we're going to deal with a double crop of having a very large crop into the world environment. World carryouts in soybeans are very big right now. And so I think that Dees corn for 26 could have its moment, especially on low acres. And I would try and shoot for somewhere between that 474 to 494 level for Dees 26 to get some sales done.
Well, if you're looking for more answers, we have Commissioner Gorin in the room too, so he can take care of what we didn't cover here today. Great conversation, folks. I really appreciate your input. Randy Martinson, Bryan Doherty, Kristi Van On, all rock stars. You hear them all the time on the Red River Farm Network. Please show your appreciation to them if you would.
It's all about nutrient efficiency, right?
Exactly.
I've taught you all the things that you know.
Oh, yeah, here we go.
I'm Sherry Cook. I'm passionate about helping farmers with crop nutrition, and I'm here to help you with your operation.